a quick update. If anybody doesn't know Neil, it'd be surprising to me since mostly everybody in our industry knows who Neil Walter is. And I appreciate you jumping in and spending some time talking about your perspective on what's going on in the market. So the opening thing, Neil and I didn't talk. I had Matt Curtis was great to get Neil on today, and so I didn't have a whole lot of questions. I kind of wanted to leave it open to Neil to be able to discuss what he sees as important and what's not important, and then I have a few questions once you're kind of finished, we can kind of get on. But if you want to get started, Neil, with what you're seeing in the market, that'd be awesome. Can you hear me okay? I think you might be having some sound issues.
I'm sorry, you just started breaking up on me. I couldn't hear you.
Oh, that's okay. Can you hear me okay now?
Actually, I can't. Just a moment.
Is that me, guys?
I mean, I can hear you just fine on my end. I don't,
Okay.
Robert.
Thank you.
I can hear you too.
Yeah, sorry, but I'm having a hard time hearing you. It sounds like we're having an internet connection issue, and I switched back to my switched off Wi-Fi, but I'm still having a little bit of difficulty.
I can hear you pretty great now. Can you hear me okay?
Hold on just a second.
Okay, no problem. We all kind of go run through that challenge. I still have flashbacks. The very first meeting we did, my Wi-Fi dropped right as the meeting got started, and I had no connection at all. Everybody was just sitting there and wait. Luckily, we still have a lot of people still jumping on, so be a little patient with it.
Hey, this is Neil. I just walked over to Wes's desk really quick.
Yeah, that's perfect. That sounds good too.
I think the phone line, you know how you dial into the phone, I think the phone line that I was on went bad all of a sudden, so I apologize for that.
No, that's all right. So I'll just recap because I wasn't sure where you missed. So I just kind of did a quick introduction on you, but we'd love to hear your perspective on what's going on, whether it's on the commercial side, residential side. I know you have a pretty extensive background in economics and teaching at DSU, so I know a lot of us are jumping on just to kind of hear your perspective on what's going on in the housing market in particular and what you see the health of the market is now, and we'd love to hear your perspective.
So happy to take a few minutes today. Thanks for having me on. There's a couple of things that I think that are important as we're watching what's happening with this market. The first thing is that we recognize that the largest market in the world and in the United States, just slightly smaller than equities, is the housing market. And everything is going to, in real estate, is really going to be anchored around the housing market. If the housing market performs well, everything else will manage. There's going to be some softness in certain sectors, but really the housing market is the critical canary in the coal mine, to use a cliche. It's the canary in the coal mine for real estate. And so a couple of things that I think are really important that we're watching. The first one is that you started about talking about interest rates right at the very beginning, but interest rates remain historically low, and they're going to continue to remain low for probably at least another year. That's our forecast, and the reason why is because the government has determined that that policy is the best policy for the country. And so they will spend whatever money is required to ensure that interest rates remain low. The second thing is that housing inventory also remains low. And we just don't see housing inventory balance changing. There's two reasons for that. The first one is that although it feels like we're building like crazy, relative to 2006 and 5, we are only building at about 60–65% of those peaks. And so the peak that drove much of the market into recession, we're way, way off those peaks, even in a very strong housing market like St. George or Las Vegas or Salt Lake. And so we just don't have enough supply. The other problem with supply is that, frankly, people just don't move as much as they used to. The average tenure in a home was as low as 4.5 years in 2002, 2003. We're up over 9 years right now, and so you just don't see as many people selling and moving, which means that you have fewer homes coming to market. And in addition to that, you have, although we have a lot of construction going on, it's relative to the last peak, there's not as nearly as much construction, and so we don't have an oversupply like we did in 2006 that led us into the significant correction.
When you're talking about those two, that's really specific to St. George, right? That's not because some of those numbers are national numbers, but really, are we talking St. George and Utah, or are we talking kind of nationally?
Those are the numbers both in St. George. Those are also the numbers nationally. So you don't have two trends going on here. Okay. Sometimes we think that our community is very different from whatever the national trend is, and in some cases it can be, but in this case we're talking about the same trend. So there is a not as much construction both locally and nationally, and there is not as much inventory coming to market both locally and nationally. So if I'm kind of characterizing three things, the first one is interest rates remain very low, and that's the most important impact there is affordability. The second thing is supply, and we still are very, very short supply. If you see the supply get long, or if you see the supply get to the point where we have a very large inventory of unsold new construction or existing homes, right? That'll be concerning. The third one is on the demand side, and the demand side is still very, very, very strong. And even through COVID, we've seen, what some were very worried about might be a collapse in demand, but I think COVID has done exactly the opposite. And this is where Utah is different. Utah is, and southern Utah even more so, is going to be one of the most attractive places in the country to go. And the reason why is you have a low density population, you have a smaller community, you have a work from home trend, and you have a state, I don't think people know this right now, but Utah has the lowest unemployment rate in the country today. Right? So if your job allows you to work from anywhere, you want to go to a place that is stable. There is space. There's a good quality of life, right? All of the things that have historically been drivers for the St. George market have all been amplified in terms of their attractiveness. Demand across the country is actually very, very strong. And even in a place like Las Vegas, this is crazy, but in Las Vegas today, you would think that maybe housing would be getting set for a collapse, but there are people standing in line to buy homes at the new home builders. And the reason why is because although Las Vegas is a big market relative to us, it's a small market relative to Southern California. And if you think COVID is scary in Utah or Las Vegas, if you're in Southern California, it's a whole different magnitude of scale. And if you leave Southern California and move to Las Vegas, you went to a small rural community.
Yeah.
In context, right? 20 to 25 million people to 2.5 million people. So even a place like Las Vegas where you have 35% unemployment today, they will be opening casinos starting June 4th. But you're seeing a massive influx of people from Southern California. So we think housing is going to perform very well this year. This is absolutely not the last recession. It's not a housing-led recession. It's not a real estate recession. On the commercial side, I think you guys have had Wes talk about this a little bit. Well, the big nationals have come out, the big national tenants, some of them have come out with lease renegotiations, and people are losing the equivalent of roughly a quarter's worth of revenue, some more, some less. The mid-size and the regional and the local tenants have been actually a lot stronger and been a lot quicker to pay. And so we think that obviously hospitality's been impacted, but it's recovering. I think we'll recover quickly. It may not go back to its peak where it was, but I think we'll have a good recovery. Multifamily has held up better in Utah than in some of the other markets. You're going to have retail, your traditional malls are just going to continue to get annihilated. But on the industrial side, industrial is going to remain very, very strong. And so when we're looking at, office, retail, industrial, office hasn't been crazy strong. We think that it'll kind of just keep moving along, led by medical office space. But industrial is going to stay very strong. Retail is going to have selective weakness. Hospitality is going to have select issues, particularly depending on the property in the market. But overall, from a real estate standpoint, we think that real estate is going to be a leader, relatively speaking. It's going to be a leader in this economy, not a major weakness like it was last time around.
I appreciate that was a lot. You were firing away at a lot. I was trying to keep up because I had some data to support a lot of what you were saying. I was trying to kind of show some images to help support some of that stuff as you were cruising along. I appreciate that was a lot of information. So kind of just diving right into that as far as real estate being the leader. I had used the analogy a couple of times, and I'd love to hear your opinion on this kind of being a tornado where some markets and some sectors of the economy might get really obliterated. You mentioned, large scale retail, and other sectors of the economy might boom out of that. Do you feel like here locally, do we have a good enough mix of different economic sectors that it won't really hammer anywhere in particular? It might hurt a few things a little bit, but because we have a pretty diverse mix of the economic sectors, do you feel like that's a valid point, or do you think I might be off on that?
I think there will be individual deals on individual properties. I don't think that there is you can say if you just go buy anything in this space, you'll be okay. So, for example, restaurants are a great example. If you're a restaurant and you have drive-through, you've done very well, relatively speaking. If you're a restaurant and you're dine-in only, you are working very, very hard to recover right now. Right. And so it's hard to paint a broad brush. In first week of last week of March, first week of April, the sentiment was if you're in vacation rental, you're in big trouble. Today, if you're looking at vacation rental, you're thinking, well, maybe this isn't so bad. Right? Yeah, I was thinking about that. I think we'll see some individual properties that'll come up and be deals. But I don't think I'm very cautious, particularly in St. George, because I think St. George is going to be one of the most resilient places in the country to paint any kind of a broad brush or make a generalization. Yeah, so I pulled up here just the employment by occupations and types. And I think the one, and this is from 2017 data. So 3 years ago, that could be kind of outdated data. But as I went back and I was looking at 16 and 15 and 2014 data, there's not a lot of huge swings. So even though this is 3 years old, you could kind of anticipate that this mix is probably pretty similar. And one thing I noticed is that there's not one overwhelmingly strong occupation group out of all of them. And that's what made me feel a lot like you did about there's not like a big broad brush that you can say other than that we have a pretty healthy mix of the different economic scenarios. Does anybody else have any questions just before I bogart all of the questions? I think I would just make the comment that with regard to those occupational mix, the construction and real estate sector were a much larger portion of the Washington County economy in 2006 than they are today. And so in 2006, when you had a real estate-led recession that was, real estate related, either construction, subcontractors, mortgage, real estate title, when that was almost 25% of the economy and that led us into recession, that was a major impact to our economy. This time we don't have a real estate-led recession, number one, and number two, the exposure in that sector, even if that were the case, it's less exposure. We definitely have a tourism and travel and led recession, and that part is gonna impact our international travel. But I think we're already seeing an increase in local travel that will offset some of those losses. And I think we might be surprised this summer how well that recovers at, for example, a place like Zion National Park in Springdale.
Yeah, I was thinking through if the social distancing is a requirement of businesses moving forward, the nightly weekly market probably won't get hit as hard as I initially thought, because hotels are going to have a really hard time having a certain margin because they have to pack their one building, where nightly weekly rentals, you can go travel and not be in this one particular building around a ton of different people. So I think that'll be the logical option for people wanting to travel. And luckily for us, we actually have a pretty huge market of nightly weekly rentals to still rent from. Matt, have you been watching the occupancy of those nightly weekly rentals? I know you had kind of been paying attention to what those look like.
Yeah, since in the last couple of weeks, we have been fully booked every weekend for all of our almost fully booked. It's been fantastic.
Yeah, that's great to hear. Neil, thank you very much. I really appreciate that. Does anybody else have any other questions? There's a lot to unpack there, but
one thing I just wanted to ask is that it seems like the reason that we're not building faster than we are is just lack of labor, right? It seems like there's just not the pay for it in St. George, so it just doesn't make sense to be a construction labor. And so every builder, subcontractor is looking for more help, and they can't build as fast as they would like. Does anybody have any insight if that's really the case? Or because if we are in this high demand, just the nature of builders, they build more homes, right? We build them faster, we'd get more product out there.
Yeah,
I think he's right. This is Matt, Lou, Washington City. Just to get in touch base with my boys out in St. George City, and with what we're looking at, we had a record month as far as building permits pulled in February, which is 91. And then again in March it's 66. So obviously the adjustment on finding labor and trying to find people to go to work, you're a little bit lower in April, which is 31. But the interesting thing is, so far in May, we're at 44. Last year we were at 40. And 44 permits represents, the top, the third highest in the last 15 years for Washington City.
Wow.
So I think, Chantry, I think he's nailed it, because it's just hard finding people to go to work. Therefore, the lag in actual pulling permits reflects that challenge.
And I don't think Brett Burgess is on today, but 2 weeks ago, he did make comments, and I think a couple other people corroborated around developers and builders initially had plans to have takedowns of multiple phases, and right around March they held off. They said, well, maybe I won't have as many takedowns and develop as many lots. And right starting April, end of April, they all changed their mind and said, well, we'll keep pushing forward. Demand still seems like it's there. So it kind of marches right along with those permit polls, where we hit a low and then it popped right back, rolling pretty quick shortly after that. So it sounds like that probably is a bottleneck, and I don't even know how we could even drive more labor into construction. But the
solution is you'd have to increase pay to bring more people into that industry, which would then increase the price of the home.
And it's that's a long game, right? Like we would have to, if we started doing, incentives to bring people in to start building, are we actually building at a healthy rate, or is it an unhealthy rate? I would say it says construction accounts for 6% of occupations in Washington County, based on the numbers that I had here. And based on our growth in those permit numbers, Matt, would you say that that's a fairly healthy number? Do we want to continue to see around this many permits pulled, or would you say we probably need it to ramp up because of inventory being so low, like what Neil was talking about?
That's a great question. Again, I think it's a fine line. We always, again, I'm speaking on behalf of municipality, we always seem to be catching up instead of being, we're always on a reactive stance, which is negative on us. But I think we do need to really look at where we're at and kind of project a little bit, or stay close to you, and others in the industry, and say, what does the data, what does the numbers show, and try and gear up and be a little more prepared, because I do think there will be a little bit of a spike, a little bit of a correction, but it won't go low. It won't go down. I think it'll be going up, especially during this whole COVID thing, where people realize, hey, I can work anywhere I want to. I can work remotely. I can work anywhere I want to. Why would I want to live and stay in California or New York? Let me go find someplace else in the country that's a lot more, open and a little bit less risky.
I've heard that a bunch. I've heard that from a lot of people, and Facebook just came out and said that their entire workforce, they were going to allow them to work remotely anywhere in the country. And a bunch of other tech companies are going that same route and saying, hey, go work wherever you want. We can move our whole workforce remote if we need to. And at this point for Facebook, it looks like it's actually a better margin for them to do so. And more companies will probably follow. And why wouldn't they want to come to a beautiful place like St. George? We're still a smaller town. We have a lot of beautiful things that people want to be a part of. And luckily, being a tech town, we still have a lot of the things that they need to be able to do that.
Let me just jump in here really quick. I think the important historical context is, if you look at the last 5 years, we had to build 2,778 units just to keep track, to keep pace with
Neil,
the
I love that you
growth.
knew the exact number. You knew the exact
It is.
number. It's what was it?
Yeah,
I'm going to write it down. 20 what?
It's 2,778. So we grew from 154,615 people to 186,618 people, this is our county, according to the Chem Gardner Institute, which publishes population estimates for the state of Utah. And with our balance of second homes and vacation rentals, and then primary residences, and using the census data to kind of track the overall housing stock, we needed, over the last 5 years, we needed 2,778 units per year, both of single family, detached, attached, and multifamily, to be able to meet our housing demand over the next 5 years, and then the next 5 years after that. So over the next 10 years, using the same population projections that the state has come out and provided, we need about 2,700 units a year, 2,700 units a year to keep pace. And then the question now becomes, are we growing faster than the state's projections or slower? And right now we're growing faster, which is why our the number of building permits is higher. And I think Matt gave us a great overview there of what's happening in Washington City, and I think that's reflective of the community. But ultimately, over that long run period, we have to build 2,700 units if the growth rates that are projected by the state are accurate. By the way, the growth rates that they're projecting are the lowest growth rates that we have ever seen in the last 50 years. So if we just hit historical growth rates, those numbers of 2,700 units underestimate the number of housing units that we need to meet demand.
Do you feel like those estimates, how accurate have they been? You might not know, but it sounds like you probably do. How accurate have those estimates been? Do they track them pretty well within a certain margin of error?
So they've always, in the 90s and in the early 2000s, they were under. So we actually had, the estimates were too low. We had more people moving than what was projected. From 2008 to 2012, there were more people projected than what actually moved here. And now that's reversing again. So now their projections are under, there's more people moving here than what the actual projections are. So the way these projections work is, in the short term, they're always wrong. In the long term, they tend to catch up and be pretty good. But in the short term, year to year, they're almost always wrong. And so right now what's happening is there are far more people moving than what the annual projections would indicate, but they know that there's going to be fluctuations up and down, and so they're betting on it being good over the long run. I still think, though, that if the overall trend is towards, you know, smaller communities, lower cost of living, more spacing, more open space, if that's the nationwide trend, then we will exceed the estimates that were provided, because they didn't account for a shift in people's preferences towards a place like St. George, Utah.
And a pretty dramatic shift, right? It seems like this is an abrupt shift in people's perspective on that same thing. I could ask 500 more questions about that projections out, just from the sense of, you know, is it better to over project or under project? Because if I'm a city planner, I probably want to overestimate the population growth, because I don't want to be playing catch up. That doesn't do well for setting budgets and things like that. But I try to stay away from that on this kind of a call. Anybody else have any other questions? That's great information. Thanks, Neil.
I just want to know what the average growth rate per year is. Historically, we've always been at 4%, you know, up and down all over the place, but historically that curve just remains the same. Neil, do you have any information based on that for recent years, and what's your projection for the next 5 to 10 based on just that number only?
So from 1970 to 2006, it was between 6 and 6.5% was your, depending on how you're measuring, it was your average annual growth rate. From 2006 to 2016, it was right around 3%. The growth rate more recently is between 3.5 and 4. We thought that it might start to slow down, but my guess is that we'll remain in that 3.5 to 4% rate based on what's happening with COVID. You got to remember that it's tricky, because 4% growth rate today is actually more people than a 5 or 6% growth rate 10 years ago. And the reason why is because we have almost 40,000 more people in the county. For example, in 2010, we were about 100. Yeah, we're about 140,000 people in 2010. And so when you start applying growth rates, you know, compared to today, where we're estimated to be 187,000 people, right? A smaller growth rate on a larger population base is actually more people.
Yeah, that makes a lot of sense. Thinking through going into interest rates, Chantry, thanks for being on, and Neil, thanks again. The interest rates, I've seen articles, they're hitting another, you know, record low. I believe it's for the month in this quarter of record lows. So it's not all-time lows, but they're hovering around that 3% nationally as an average, like 3.15 is what I was reading today. Can you give just, at least from the Guild perspective, what are the rates looking like? Do they seem like they're still healthy? I know application polls have been up, and we're still trending in that direction, which is all good news. Can you touch on that?
Yeah, so I actually pulled up some just historical rates, and they're pretty similar to what I'm seeing for us. Like at 30-year is at 3.25. 15 years at 2.75, you know, something like that nationally. Yeah. And we're pretty similar. I've been doing mortgages for 14 years, and I honestly have never been locking loans below 3% on a 30-year until like the last couple of weeks.
Yeah.
So we've been seeing borrowers getting 2.8, 2.9 on 30-year mortgages, which is just crazy.
Yeah. And thinking about re-energizing as realtors, right? And our consumer base as buyers and sellers, and our clients are relying on us to do quite a bit to help them navigate what they should be doing. I would probably see that the ones that missed the refinance wave of 3 months ago probably have an opportunity to hit it again if they missed it. Would you say that's pretty accurate?
For sure. Yeah, absolutely.
So at least that's what, you know, as far as my coaching goes with my brokerage, is the agents, if buying and selling isn't an option, refinance should definitely be on their radar if they haven't already. more recently. Looks like Austin Aiken dropped in a question. It's a long question here, so just bear with me. I'm gonna read it real quick. You mentioned the effect of COVID-19 on the drive-through restaurants versus dine-in only. I can certainly testify to the increased demand for drive-through space here in town. Do you see that actually creating a paradigm shift in restaurant and retail space going into the future, where we end up more retail centers designed around facilitating drive-through and pickup business? In short, will the current increased demand for drive-through stick looking in the future? So that's a great question. The only thing I'll pause if Neil, if you want to drop an answer in there. I want to kind of keep along the lines of the mortgage rate, since I got Chantry on here, and then Brent, if you want to jump in. I see you're on here as well. The mortgage rates being low, and I know the government has used that to kind of help add incentive for demand. I see the biggest challenge still being inventory is still super low here in St. George. Are you finding, Chantry, that your clients, the ones that you pre-approved, they're having a hard time finding the home that they want to go get into?
Yeah, especially under 300,000, right? Because there just isn't many options available to them. One thing for you guys maybe as real estate agents to take away, and I talk about this all the time, is that you get people that are nervous about home values going up or down. And currently we're obviously low inventory, and so there's no immediate time of going down. But I think Neil touched on the fact that, hey, at some point, we probably will see some sort of a recession that isn't COVID related. A 1% increase in interest rate typically equates to about a 10% change in home price. So if you just kind of think about that for a minute, on a $300,000 house, if interest rates are at 3% and now they go to 4%, that same $300,000 house would have to go all the way down to about $270 for you the same equivalent mortgage payment. And when I talk to folks, it's like, hey, I'm not saying interest rates are going to go up this year, and they may. There's a really good chance they may not, but they also might. And do you see, and the question would be, do you think interest rates could go to 4%? I mean, Robert, how weird would that be to you if at the end of this year interest rates were 4%?
It wouldn't be too weird. I mean, it'd be a little odd, but I wouldn't be like, oh, that's really strange that they went up that high.
Rates are still good, 4%. My gosh, yeah. That's incredible historically, right?
Yeah.
If you have a home, you just got a townhome, right?
Yeah, I did.
How much? Just rough figure.
280. Cade End. He sold out an entire subdivision. Well done, Cade.
That house would have to go down to like 250 or 255 for the same house. Could you see at the end of this year your house being worth 255?
No way.
That'd be like the market fell out.
Mm-hmm.
Complete. And for that to happen, it would basically be a complete collapse.
Right.
The buyers that are on the fence because they want to time the market and this, that, and the other, I think they're completely missing out on maybe values stabilize, maybe values go down just a little bit. But at some point, who knows when, right? But at some point, interest rates aren't going to be 3%. There's just no possible way that remains.
Right. Yeah, and I think it's important to note, if we're having those conversations with our clients, is even the top money managers in the country say that it's impossible to time these markets, right?
Right.
You can get kind of roughly close, but we're talking, especially in real estate, you're close within like 12 to 18 months close, right? Because that's how slowly these prices change. I think when it comes to what the values are, I'm going to share my screen. This is just from the Washington County MLS, and this is as of April. So we're end of May here. So in 2 weeks from now, we'll have better data just for the month of May. But everybody can see these market summary for April 2020. I think this is an interesting point right here, is that the median list price in April of 2019 was basically $400,000. It jumped $30,000 year over year in the month of April as to the list price. And if you look at even the median sale price, it jumped up again at roughly $30,000, right? So using that, the logic with the mortgage interest rates and those interest rates going up, the prices are going the other direction, right? And if it's going to take 12 to 18 months to see prices change, the idea should be, I don't even know how these things are happening on my screen. Somebody might hijack me. These things here, it's important to note that the prices are going in a different direction. And interest rates are going this direction and prices are going this direction, that means that it's never been really a better time to buy or sell. I don't have no idea how somebody is hijacking my share here. These are like the nightmares you hear from people hijacking share screens. So thinking about that, if we go back to what those numbers say, and the question that was dropped in here about the jumbo home market, I've had a lot of people ask, well, what's going on the high end market? More homes have hit the market, but I don't see the demand going down. We're still seeing homes sell in the higher end market. The days on market is creeped up slightly, but it's a negligible change from the market statistics that I'm watching. And so looking at and watching that on a regular basis, as long as it's continuing to go in that direction, it's not something that we should try to forecast out and say, hey, you should wait 12 months before you do something, because like Chantry said, the interest rates could go up a full % and prices more than likely aren't going to swing all the way back the other way to go and start to reseed. So somebody's wanting to buy a house and they'll be there for 12 to 18 months or even 5 years. They're probably still in a great position to buy it now. Real estate's still pretty strong. Anybody want to comment on the mortgage rates, Brent?
No, I agree with Chantry. He put it very well. You're buying a house, and if you can get a great rate, that's just a double bonus. So,
yeah, for sure.
Two other
Hey,
things
this is
that I
Neil.
thought I
had to-
might touch on, if you don't mind, just because it's what we're facing every day, and it's the commentary that we're seeing, is borrowers that have opted in for the forbearance, to where they delay their mortgage payment, and then borrowers that have been furloughed from their employment. So there wasn't it's obviously new territory. And so there really wasn't a lot of guidance on either of those until really pretty close to last week. So the borrowers that are in forbearance, because we were worried that, I mean, if somebody misses a mortgage payment, they're probably not getting a new mortgage for 12 months. There are exceptions to that, but for the most part, like if you've had a mortgage late in that last 12-month period, you're in trouble. So we didn't know what that was going to mean in terms of forbearance. So the good news is the forbearance is not reporting late to credit. Borrowers that are, this is for refinancing or buying a new home. If they've entered into a forbearance and they're still continuing to make their payment, because that actually happened quite a bit. People panicked, called in, got approved to do forbearance, and then decided, you know what, I can actually make my payment, and they just did. And that was probably the smart thing to do. Those folks, no time waiting period, no penalty, no anything. They could buy a house technically tomorrow. Borrowers that opted in and did the forbearance and haven't made a few of those payments, once their forbearance period ends, they need to have made 3 consecutive on-time monthly payments before they'll be eligible to refinance or purchase a new home. And that was a little bit more lenient, to be honest, than I even thought it would be. And so I think that's good news. And it still isn't, it's not a negative hit to their credit.
Yeah.
As mortgage lenders, we're also having to check, because most mortgages are not reporting anything negative right now at all, even if you're not in forbearance. So like us at Guild, and I think most have followed suit, if you're not in forbearance and you didn't make your payment on time in April, they're not marking them for a late. You still owe the money, but it didn't have a negative hit to your credit.
Do you think this is a building tidal wave, though? Is it?
Yeah, it is. And one of the challenges mortgage lenders are having is that you get a borrower that's had some mortgages and their credit doesn't show negative, but if you dig far enough in, you'll find out that they haven't made some of those payments, right? And it could be this, exactly like you're saying, tidal wave. So we're having to get proof, bank statements, most recent mortgage statements, to prove that they've been making those payments, because the credit report isn't reflecting that.
So if I'm an agent and I'm having conversations with my database and my clients, potentially if I have a great relationship with them, the conversation could be, if you're fearing making these mortgage statements anytime in the near future, potentially selling is an option. And so we could see a little bump in short sales, potentially trying to get out of this if they feel like 3 months down the road, it's just a building mass of money that they're not going to be able to pay back. How long do you think that lasts before they say, oh, we're going to start reporting these late late payments or non-payments?
For us specifically in Guild, the last I seen is that a 30-day late, if you don't make your payment in June, technically 30 days late on your June payment, we're reporting a late payment marked on your, which means basically July 1st.
So they're not doing month over month. We're talking 30 days. You're getting basically a month pass, and that's kind of it.
Somebody, as of right now, if somebody doesn't make their June payment July 1st, we're hitting their credit as a 30-day late.
Got it. Is that same across?
Because mortgage payments aren't considered late from a credit standpoint until they're a full 30 days late. They're due on the 1st, but not, you get a whole 30 days to actually make that before it hurts your credit.
Got it. Anything about ITIN loans? Kim Prado asked. ITIN, I'm not familiar.
Yeah, so currently the agencies, which are FHA, conventional, and VA, from my understanding, and maybe Brent, or I think I see Kia, a couple other mortgage lenders, they don't accept an ITIN. So if you're doing an ITIN, it really would be more of a subprime loan, and those are basically non-existent right now. It doesn't mean there isn't maybe one or two programs out there, but everything that we're seeing, I don't know of any options. Maybe anybody else can chime in.
I believe we have one option for it, but it requires like 25% down. It's not a great option. It's not a good interest rate, but it is available.
There you go.
And then if you hear of it,
I bet that, any options that are available, I bet they're very similar to what you guys are offering, right? I mean, I think that's probably the deal.
ITIN, can somebody just give me a quick nutshell what that is?
Is Kim doesn't want to share? Basically, they don't have a social security number yet. They're not a U.S. citizen, and they're still working on and I don't know some of the details, so someone correct me if I'm wrong, but they don't have their permanent residency. They're actually okay to work here kind of on a temporary status.
That's right. George and I were talking about that last week. Now that makes sense.
The reason the mortgage industry is a little bit weird about that is that it's technically temporary in nature.
Yeah.
So there could be a point where you're no longer able. My understanding is you're no longer able to be here, right? Because your status has expired.
Yeah, it's temporary status, not permanent, right?
Yeah.
So that's where that.
And then the last thing, maybe I'll just touch on furlough, because we did have a handful, and we've actually closed a couple of them in our office, of borrowers that were placed on furlough. And in general, the mortgage industry so far has been fairly flexible with this. We just had to document that the borrower had returned to work now. He had returned to work at the normal capacity at the previous pay he had before. We got a little written letter from his employer kind of saying that whole thing. And then we just had to get one pay stub. And I thought that wasn't too bad. And they kind of just took that month or two almost out of his income equation and just said, hey, it was completely, almost like a natural disaster, I guess you'd call it. It was completely out of their control. And so we're just going to take that out of the equation that month he was on furlough.
Got it.
Only ones that'll be a struggle is and I don't think we're seeing it as much here in St. George, but like Nevada, if casinos open and the guy's gone back to work, but he's really not working the same hours as he was before because it's kind of barely open, sort of a thing, that would pose an issue. He'd probably have to be back to his previous income level.
Yeah, it's been interesting to watch. Even though there's been some tightened up restrictions around getting loans, demand is still crazy high. I mean, we've had some pretty record numbers. Dave can attest to this, of contracts we've been pulling in here at the brokerage. One thing I will note, and I think because it's across, I'm sure it's across the board, and I'd love to hear some from other brokerages. The agents in my market center, the top producing agents in my market center, are the main ones pulling these contracts in. I've seen a sharp separation between agents that have been doing business consistently in the past are capturing more of the deals as a percentage than they have previously. A lot of the agents that have been closing, between 10 and 30 deals, inconsistently over the last few years, they're doing less and less deals. So it's interesting to watch the agents that have been focused and consistent with their lead generation and connections with their client base. They're the ones that are putting these deals under contract. Is that the case? Are you seeing that? Anybody else in the room see the same thing? Is it kind of this separation out? Maybe I'm the nerd that watches those
I'm going to
numbers.
chime in, speaking from us, mortgage standpoint. You mentioned that they haven't really noticed a big change. We had a handful of deals at the very beginning that fell apart because people lost their job or got panicked and decided not to sell their house and stuff, but it was very minimal.
Yeah.
Like I'm talking like a handful maybe.
Yeah. And I think it's interesting because we all put into our mindset that there's a big change, and there wasn't as much of a big change as we all kind of put into our own minds. And I think that's where those top producing agents, those agents that were consistent with their work and didn't let things change too much, are the ones that are kind of reaping the number of transactions that are falling down. And even though there are some hiccups, there are some challenges around getting loans. It's not impossible. The faucet didn't turn off. And if I pull up these numbers, and this is of April, and I know that it's going to be consistent as of, I'm nervous to share my screen again. Somebody's jumping into it. If you look at here, the number for sale year, April 2019 versus April 2020, our supply is down 7%. Our under contracts are down 27%, and our number sold is down 21%. But in this month, this is swinging far. Those under contracts are swinging far back and right back on pace with probably May of 2019 this year. And so I'll be interested to see in 2 weeks when we meet again what the May numbers look like. But that inventory is down. I know for sure our inventory is down year over year. And so that's going to be our biggest challenge, is getting that inventory up. And Neil touched on needing 2,700 units per year built. Matt Liu saying that, the number of construction pulls were down a little bit for a couple of months, but they're right back on pace. So hopefully the builds can continue, and we need to have great conversations with people that are wanting to sell their home, that it's still a great time to sell their house. They're getting a ton of money for their house, and they could still upgrade into a nicer house or into a different house at a great interest rate. So it's still a great time both to buy and sell. That's my opinion. Does anybody else want to touch anything? We're at 9:48. I don't like to go too long. Anybody else have anything else they want to touch on? Was this helpful? I think Neil, man, that was a great, a lot of great information there. I'm gonna have to watch this over again to just digest all of it. But anybody else have any questions? I'll hang out here for just a minute. But that's all I have for everyone today. Thanks for jumping on, and we'll be back in 2 weeks to kind of continue the conversation and try to drive some new stuff. Thanks, Neil. Thanks, Chantry, for jumping on.
Thanks for putting these together, Robert. Neil, that was amazing.
Well, that's good.
Absolutely.
I'll hang out here if you guys want to chat a little bit more.
Robert, if we're gonna rewatch some of this, where are you posting that at? Out of curiosity.
Just because it's a big file, I end up having to throw it on my YouTube page, and then I'll share it onto Facebook. I'll also I'll email a follow up to everybody that registered for the class. I'll email a follow up to them with the link to the YouTube page. They can rewatch it as well, or share it if they want.
Okay. Cool. Perfect. Sounds good. I appreciate you guys, man. Thank you.
Yeah, you're welcome. Hopefully it was good, man. Sean, great thumbs up, man. I like the use of the reactions of thumbs up. Clapping. I'm gonna have you on next time. I need Sean to share all his wisdom. McCrae, let's think through who else we can have jump in with some information.
All right.
Does anybody else have any suggestions? Who would they like to hear from out of those that are on right now?
There's a really great group of people that's doing the similar thing up in northern Utah. It's Silicon Slopes guys.
Oh yeah, I've seen some of the invites of that. Yeah.
Yeah, it's really, really good stuff. So there's a few kind of movers and shakers up there, I think because they're kind of focusing on that northern Utah Salt Lake area, but they've been doing helpful info like on how to apply for PPP loans and just good stuff for business owners. So it might be good I'll send some email info for you on that. Maybe we should invite them.
Yeah, that's a good idea.
I got to roll. I'll call you.
See you, buddy.
See you guys.
Okay, seems like everybody's, I'm dropping like flies. Matt, thanks again for your help. Wes, thanks. We'll see you guys in a couple weeks.
Shut us out.